Welcome back, traders. It's John. It's November 3rd, Friday, and I'm recording this video at around 3:15 Eastern Standard Time. So as a reminder, this presentation is made by Rain King LLC. I'm an amateur individual growth stock investor. So our quick agenda for this Friday is we'll go over the indexes, some sectors, take another peek at sentiment to see what's happened in the last week. Then we'll update our trend monitor, and then we'll wrap up. So let's dig into this. Let's dig into some of the indexes. We've had a very, very interesting week. So this is the NASDAQ daily as of yesterday. And we had a follow-through day, day 4 follow-through day of 1.64% on an increase in volume from the prior day. That's come after this 12.5% correction, a pretty healthy correction down to the 200-day, which has a lot of people discouraged. But we got a follow-through day. And it's also encouraging that we got back above the 20-day moving average, which is this purple line here. Today, it looks like we're actually clearing the 50-day, which is even more positive news. At the downward sloping 50, there could be some resistance, but it looks like we're going to get through there today if we close well. So that's positive as well. If we turn our attention to the S&P 500, this chart was cut again as of last night. We had back-to-back strong up days after the Fed comments we had on Wednesday. We had our first net new highs in weeks. So that's a very encouraging sign. Now, that's only one day. We'll have to see. We want to see a string of those to get into a really a positive environment. That's important to our trend monitor. Also, it looks like today will be our second day above the 20-day moving average. So again, that's encouraging in terms of maybe the trend is changing. So if we go a little deeper, I started this last week. The upper part of this chart that I created, I said there were some very early signs as of last Friday that maybe the breadth was starting to improve, particularly the October 26th day, which was an index that was down, but the breadth was positive. We've gotten a lot more confirmation of some good breadth. On the 30th, we had breadth that was actually better than an index up 1.2. Tuesday, we also had better breadth than the index. Wednesday was a follow-through day on the NASDAQ, but the breadth on the New York Stock Exchange was in line. It was not great. But yesterday, we also had a strong up day on the S&P, almost 1.9%. And the breadth was much better than the index. So we're starting to see what we're looking for, which is really encouraging within the S&P and New York Stock Exchange. Now, I called up this chart. It's a composite showing in blue the XLF ETF, and the orange is the IWM. And I took a long-term view here. This is the 2020 COVID low. And generally, a couple things you can see. One is there's some correlation between the financials, XLF, and the small caps, which is IWM. You can see they generally track each other. Now, these are important sectors because bull markets typically see the small caps participate as well as we need the financials to participate as well. They're very important, and you see them together. So it was not encouraging. We had a pretty vicious sell-off in the small caps the last couple of months. I think it went down almost 19%, almost a bear market in this leg itself. And about a week ago, I tweeted that we saw some exhaustive selling in the IWM, and we had this undercut of these prior support levels. And if you've been paying attention, you've seen both the IWM and the financials start to rocket higher the last couple of days. So let's look at the IWM a little closer. So here's how this bottom looks like it was forming. We had heavy climactic selling, these big red down days. Then we kind of had a stabilization day. By that, I mean the volume was still very heavy, but we didn't go any further lower. So any selling that was left was being absorbed. And then you can see that we stabilized with an inside day, a couple of inside days, and then we've had this powerful move in the last couple of days. We had a gap 2.67 yesterday, looks like a 2.7% gap today, though we're not closed, showing us that maybe all this washout selling is gone and that we're going to turn and go the other way. So that's encouraging as well if we get a little rally showing the small caps participating. So let's turn to sentiment. Sentiment was something that I expressed last week that I did not think was really reaching extreme levels of fear yet. So this is the chart of the American Association of Individual Investors from last Friday. And we had showed that my concern was that we were nowhere near extreme levels compared to the low we had last October. So what does this chart look like today, 1 week later? Here it is 1 week later. There's been a big pickup in the fear of retail traders. You'll notice now that we're down around minus 26. So we're definitely in bearish sentiment territory. And we've almost reached the same level of fear that we had at the March regional banking crisis. So that's actually encouraging to see the fear kick in and retail investors get scared, because they typically get extreme at the wrong levels. And you've noticed that we've started to have a rally start. Now, this is looking at the NAAIM, the National Association of Active Investment Managers, and this is their exposure index. I've shown this from time to time. Generally, and I put these colors on the chart, you get above 85% exposure by active managers. That tends to be near market tops. The mid-yellow level is kind of neutral, and then you can see that when you get to the lower end, you start to get corrections, but then extreme levels is when the managers only have exposure of 10 to 20%. It's pretty rare, and we typically see it at market bottoms. Here's the market bottom last October when we were below 20% in the pink zone. So you can see that this level was almost 66% 2 weeks ago, and exposure levels dropped dramatically in 2 weeks down to 24%. We're almost touching this extreme level. So again, it's showing us that a lot of money has been parked on the sideline or is moving into different areas. So I think that's encouraging to see active managers, and they're probably going to have to catch up and participate in this rally if the rally has legs. This is S&P stocks above their 200-day moving average. We've hit a low. We've had a very hard fall off in this number. We got down to a reading of 25% last week. You can see that we've had a sharp upturn up to about 40% above their S&P that are above their 200-day moving average. Big improvement, but you can see it's well off bull levels, which are certainly above 50 and beyond. The real low level we had last October was only 17% above the 200-day. So the question is, with this sharp rally, is this true long positioning by institutions and hedge funds, or is this simply just a short covering rally and everything was so oversold that it's just a rally that might be brief? We've had a couple of gaps. Question is, will those gaps fill, or will we just consolidate and go sideways, which would be more bullish? So the trend monitor, let's look at where we are. Before we dive into that monitor, I wanted to show this from Carson Research. They put out some data that looks at when we have a down October, but we're still positive in the index for the year, what happened in November and December. So you can see the situation is this. This year we were down 3% in October, and you can see the historical data showing that 72% of the time the market, the S&P, will be higher in November, and positive also 89% of the time for the final 2 months of the year. Sometimes it's a fairly decent rally. You can see the medians here and the average. So are we turning the corner here in November? Well, it's encouraging that we got a good burst the later part of this week. We'll have to see if it continues. And as a reminder, we have entered really the strongest period for the market, which is really November, December, and January tend to be the strongest months for the stock market. So this sideways period that we've gone through is really very similar to all pre-election years, where you go sideways pretty much or correct slightly in August, September, October. So right now it looks like we're going according to the historical plan. So back to the trend monitor. We talked about what we look for. We just got a follow through day, so we have to take that at face value. It's a day 4 follow through day, and we really want to avoid any distribution days within the next 5 days to really improve the odds that this has some legs. You remember The follow-through day previously started to get distribution on day 4, and things started to fall apart. Now, are we seeing proper bases and breakouts and good setups? Objectively, I think it's pretty lean. Now, there are stocks moving that are gapping up, but are they breaking out of proper bases? Not that many. There are a few, so we have to be selective. Now, are we seeing net new highs? Well, the NASDAQ was still seeing net new lows as of yesterday. The S&P was more encouraging. We saw our first day of net new highs, as we mentioned, and we'll have to see if today continues that trend. So this is a little bit split, but that's better than it was a week ago where it was very negative. Do we have 3 days above the 20-day moving average? Not yet, but if we close today positively, we should be our second day above the 20-day, which is also encouraging. Breadth, are we seeing some positive breadth, 3-to-1 up days for a couple of days? I told you this week was very encouraging on the breadth side. Under the surface of the S&P, the breadth has been improving, so that's a very positive sign. If it continues, I would expect to see the net new highs really start to string together positive numbers of net new highs. So we'll see if that improves and continues next week. Volume, the day 4, we've had a 4-day rally, and the volume has been pretty strong as we're coming on this rally. So that's encouraging. We want to see how it handles itself as we go forward. So we observe things day by day. So to wrap up, we have this follow-through day. It certainly gives you a license to hunt, but I do recommend you be very selective. There are a lot of damaged charts out there, so make sure when you're looking at a chart, you're really doing the work and looking for signs of accumulation versus distribution. In these videos, I've shown a number of ways how to do that. So you can't skip the hard work. You got to do the work and find a situation where a stock is under accumulation. There are a number of stocks that are gapping up, but they're deep within their bases. Things like AMD and Chipotle, Shop today. So they're gapping up, but they're not at all-time highs. So that's a little bit of a caution sign. It's not the best situation. Doesn't mean it can't work if you're a short-term trader. There are some significant high volume close overhead resistance in some charts. Apple today ran right up into its high volume close. Looks like it's rejected there. Meta is meeting resistance at its high volume close. And Amazon and Roku have some high volume closes above in their charts that could potentially be resistance. There's also some moving average resistance, some downtrend lines and moving averages that are restraining names like NVIDIA and Tesla and Google. Probably the list of stronger actors at this point would be stocks like ANET, Deckers, which are really strong, CCJ, Crowd, ServiceNow, as well as Palantir, which looks like it might be poised to make a breakout. So those are some of the better names right now. I will disclose that I have a position in Palantir. Now, we see a lot of things rallying. The IWM is rallying, the SOX, they're all attempting to rally. We have to really watch the action because there is overhead above. And there are some gaps that were created this week. Many times gaps come back and we fill those gaps and we have to do a little backing and filling. So we want to watch how stocks act, these indexes act for clues to see if this is calm and normal or is there rejection at some of these resistance points. Again, we're looking for additional trend change. We're getting some positive things, but we haven't fully turned. And we know we're in a strong seasonal period, so that's encouraging. And keep your watch list fresh. Build your watch list and let the market pull you in. If your test buys are starting to have some gains, then you really earn the right to have some more exposure in the market. If your test buys are not working or you're underwater, there's no reason to put more exposure into the market. So if you were going to add a name that you really liked, you probably should cut that loser quickly. Exposure levels, I think, are still a little constrained. I think 10 to 15% might be appropriate here. There just wasn't that much merchandise that was in a really good position, but we want to take this follow-through day what it is. It gives us a license to hunt that maybe the trend is changing. So don't plunge. If this follow-through day does lead to something bigger, the trend monitor will improve rapidly and we'll have more opportunities to get more invested. So those are my thoughts for this week. And the quote of the week is, "No man ever reached to excellence in any art or profession without having passed through the slow and the painful process of study and preparation. That's from Mark Douglas in his book, Trading in the Zone, a great book. And it just is re-emphasizing that trading stocks is very, very hard. And it takes a lot of study, a lot of experience, and it's a painful process this time, but persistence and grit will get you through to the other side if you have a good methodology and you stay disciplined. So hang in there. We might have a really good opportunity in this rally ahead into the remaining part of the year. Well, that's the general market update for November 3rd. Any of you who are signed up for Blue Sky 6, we'll see you tomorrow. We have a great lineup, and we're excited for a full day of education. Thanks, everyone. We'll see you soon.